Good morning, everyone. Thank you for joining us for today's seminar. We appreciate your flexibility as we have shifted today's seminar to a virtual platform, and we hope that you and your loved ones remain healthy and safe in the weeks ahead. My name is Christina Shoemaker, and I am Senior Vice President for Development, Grants, and Marketing at Valley Youth House. Annually, Valley Youth House empowers over 21,000 homeless and foster care youth and vulnerable families across Pennsylvania to achieve healthy and independent futures. Our work has shown that one caring, consistent, and permanent adult in a young person's life makes a very big difference. And we could not provide the services and programs that we do if it weren't for the community support that we receive from people like you. So thank you for joining us this morning. This year, we're expanding our planned giving initiatives, and we're introducing the Catalyst Society. The Catalyst Society will recognize and honor donors who believe in furthering the Valley Youth House mission and have therefore expressed their commitment by naming the agency as the ultimate beneficiary of a planned gift. Kathryn Brown and Nicholas Nanovic have volunteered their time and expertise to provide useful tools for families to understand the estate and financial impact of planned giving and how to intentionally build a meaningful legacy. Nicholas is a partner and chair of the Wills, Trusts, and Estate Group for Gross McGinley Law Firm, and Kathryn Brown is co-founder and principal of Morton Brown Family Wealth, and she served on the Valley Youth House Board of Directors from 2011 to 2019. Nick and Katie, thank you for taking your time and your expertise to join us this morning. And at this time, it's my pleasure to introduce Nick to kick things off.
Okay, thank you, Christina. All right, so there's our slides. I'm going to turn off my video for a second here as we go through this presentation, so you can all focus on the material here instead of my face. There we go. So this is our basic agenda for the day. We're going to look through basic building blocks with your planned giving, charitable giving within the family, having that discussion, building giving into your overall plan, whether that's lifetime or testamentary, strategies that you can employ, the tax consequences of anything that you do, and at the end, we'll have some Q&A. There's a chat feature on the side if you want to enter your questions there as we go through. Depending on the context of the question, we may be able to answer it as part of the presentation, but otherwise, we'll try to answer all the other questions at the very end. So starting with the building blocks of putting together your estate plan, primarily you have three subtopics here, the coordination, the efficiency, and the legacy. The coordination aspect of this is basically building your team. Who are the right people to help you with this legacy that you want to build, with any type of gift that you want to make to a nonprofit, to family members, to friends? Who's going to help you and guide you on those decisions and the potential consequences of what you're trying to achieve? So typically this includes a lawyer, a financial advisor, possibly you pull your CPA or accountant into this. You also want to coordinate among your family members and friends who are going to play an integral part of this plan. You're going to have people who will be executors, trustees, possibly guardians for children. It's important to make sure that you understand their strengths and weaknesses and what roles they can play in your overall plan as well. So that's always an important part of the conversation when putting this type of plan together. Efficiency, that's primarily looking at the easiest way to accomplish your goals, not making unnecessary steps or hurdles that can be easily avoided, and also minimizing the cost, whether that be fees, whether that be taxes, making sure that you can get from point A to point B, but doing that in the most efficient way. And then finally, legacy. making sure that your goals are accomplished and that you leave the legacy that you want to leave. Some people want to be very public about their gifts. They like to receive some recognition. Maybe that will help encourage their own family members if they see that recognition. Also, do some planned giving of their own. Other people prefer to remain anonymous, but that should be part of the conversation and be built into the plan to ensure how to accomplish that goal, depending on which side of the spectrum you're on with that. I'm going to turn it over to Katie right now to talk about charitable giving for the families.
Hi. So I just want to say thank you once again to Christina for hosting this seminar today. Today's event brings together a couple of my most favorite things: financial planning and organizations who truly make a positive impact on the community around us, as Valley Youth House does each and every day, as you work to reach your vision of a world in which every young person belongs to a nurturing community. So thank you once again for this. As Christina mentioned, I'm Kathryn Brown, and founder and principal of Morton Brown Family Wealth, and I am so thrilled to be here. So let's dive into charitable giving for families. One of the things that I love about my profession and working with families is that there are so many different facets to the conversation. There's the mechanical, black and white, numbers-oriented side, which we'll cover portions of later. And then there's this softer, subjective, kind of emotional side of the equation. And this is the area for self-reflection, for dreaming, and also for being sensitive and respectful to the loved ones around us. So if it's your goal to establish a charitable giving strategy within your family, but you're not sure where to begin, here are a few tips for building the foundation. I always like to start with identifying core values. So starting with your core values is a great place, because giving is so much more rewarding if it aligns with your values. So whether it's you and your spouse, or maybe you brought your children into the conversation, go around and discuss with each of you individually, and go around and discuss your individual values, and look for those cross sections where you meet in the middle. So when I talk about values, they may be things like you might value health, art, education, equality. And if you're not sure what some of those items are that you value most, look at where you're spending your time. So for example, my husband and I, we both enjoy working out, exercising on a regular basis. And we also spend time volunteering with youth athletics, because we both value health, fitness, and team dynamics. So just kind of an example of where to start. And then once you've identified some of those core anchor values within your family, give freedom to everybody involved. So encourage the different members to follow their passions within that core set of values, to find organizations and causes that the family may enjoy supporting together. And communicate regularly. So you may have heard this before, and it might sound a little silly, but consider setting up family meetings on an annual or more frequent basis. It could be set to a season or an anniversary. I know a lot of families, speak as we get closer to year end during the holiday season. So maybe it's a holiday conversation. Once again, my husband and I, we tend to talk about these bigger planning items usually twice a year. Once kind of leading into summer as we get clarity on our year, and then another time going into the end of the year as part of the holiday season, but then also just in our own personal review of our financial situation. And then finally, set expectations. So we talked about identifying values, giving freedom, communicating. But a question that I often hear is, there are so many ways we can give, and we receive a number of requests. How do we decide what to do when? So creating a framework for giving will allow you to better set expectations, both for the members of your family as well as the organizations that you support. And I encourage you to find a structure that's going to work best for you and your family. But here's an example of a framework that some of my clients have adopted. They divide their giving into 3 buckets. So we have, I'm going to use my little pointer here. We have the impulse giving, and this is where you set aside funds to support causes that may pop up throughout the year. So maybe your grandchildren are doing a fundraiser for their school, or a friend is participating in a walkathon. Maybe you have a neighbor or a family member in need. Sometimes this pool of giving does not have tax benefits tied to it, but it definitely falls into that feel-good category, and it's something that you set aside that you can do as you receive the impulse. And then annual giving. This bucket is reserved for organizations that you enjoy supporting on an ongoing basis. And this level of support usually ranges in size from smaller to medium, subjective based on your personal situation. An example might be giving to your church or place of worship. And then finally, we have impact giving. And this is a very special bucket. This is the place where you help to really accelerate change. The whole point of giving at any level is to affect positive change. And impact giving is earmarked for the organizations and causes that you feel most passionate about and you feel inspired to commit a larger pool of charitable funds. This level of giving may only happen every few years, such as in a capital campaign, or maybe there's a large project that's here and now that you want to begin supporting. Or the gift might be incorporated into your estate plans and distributed upon your passing. In either case, it's most effective with a little bit of planning. And so I'd like to hand it back over to Nick to talk through some of the planning components.
All right, thanks, Katie. So I want to just go over some more of these check marks. I guess I'll say a list of things to make sure you do to accomplish your plan in the most efficient way. The first, I think, is a very big one: aligning the proper documents. The planning, at least testamentary planning, includes obviously a will. It may also include a trust, but what should not be overlooked are the ways that you title different assets. For example, if you have any assets that are jointly owned with other individuals, or that you have a designation on the account, such as TOD or POD, transfer on death, payable on death, your will does not direct where those assets go. So one pitfall I see more often than I'd like when helping people with their estate plans is that they look at their total net worth and they assume that their will is going to cover all the assets. So when they say, I want 5% to go to charity A, they may not fully understand that 5% is only the assets that are inside their estate, because things such as joint accounts, assets with beneficiary designation forms like life insurance and retirement plans, those are not covered by a will. Those are going to be covered by the way those accounts are established. So it's very important to make sure you understand how all those different assets work together and the way that they are titled. Secondly, setting expectations for legacy. A few minutes ago, I mentioned that some people who have charitable intentions, they prefer to stay anonymous. They just want to make sure that their donation is used for the reason that they intend it. Other people would prefer a little bit of recognition for what they are giving. And there are ways to do that. There are different ways to do that. You can set that up during your lifetime. Primarily, that's the best way to do it, to have that conversation, whether it's going to be a lifetime gift or a gift upon death. Either way, have the conversation with the charity about what that would look like as far as naming rights or any other expressed recognition. And then third on the list here is properly naming organizations. Again, it happens more often than I like to see, but there are many times that organizations with similar names are used and interchanged, and it results in the wrong organization getting the funds that the person intended. For example, in preparing for this, I couldn't think of any specific examples off the top of my head, so I sought out anything online that talked about some common examples. There's a website called charitywatch.org. It gives an example of a few years ago, a group of unscrupulous people who set up organizations called Wounded Warrior Fund, Wounded Warrior Foundation, trying to extract funds from people as donations. And those people, their perspective was most likely that their funds were going to Wounded Warrior Project. They had no idea that it was going to the wrong organization that was set up solely to take their money from them. So that's an example of one where someone is proactively trying to take money from people with charitable intentions. But there could be situations where there are honest mistakes too, where there's an organization that someone has in mind, misstates it, and it does not get recorded properly in their documents. Also to keep in mind when working with national or global organizations, if you want the funds to stay local, sometimes you have to expressly state that in the documents that you're using, whether that be a lifetime contract or a will or trust. Otherwise, some organizations, if they're national or global, they'll channel all the funds back to the headquarters and disperse throughout the country or world, depending on how they see fit. So that's just a consideration to keep in mind when planning these gifts. And then finally, identifying the restrictions, if any, that you want to put on these types of gifts. Some people may defer to the charitable organization itself, saying whatever the board of directors decides, the officers involved decide is the best use of those funds, then great. They're the ones who are on the ground. They're the front lines. Let them decide how best to use the funds. Other donors may want to ensure that the funds are used for a particular project, for a particular fund. So that can be built into contracts or built into testamentary documents. But the important part here is just to remind yourself that this is a tool that you have at your disposal. If you do want to restrict the gift to a certain purpose, you can do that. I'm going to turn it back over to Katie, talking about different strategies that you can employ.
Hi. Yes, thank you, Nick. So I'm going to dive into a couple different strategies. Please recognize these are just a few of the more popular ones. It's not an exhaustive list by any means. Also, there are a number of nuances with each of these, and this might generate some questions. So once again, if you do have any questions, please feel free to use the chat box over on the right-hand side of the screen. And we have Maddie Miller moderating for us, which is very nice, and she'll make sure to push them through to us. We'll probably be saving most of them for the end, but if there's something that pops up as I go through this that's timely, please don't hesitate to ask. So I'm going to go a little bit out of order, my little boxes here, and start with bundling gifts. So under the 2017 tax reform, we saw an increase in the standard deduction, a pretty large increase, which for many was a positive, but it also squeezed out a number of the itemized deductions that you may have previously taken. So the strategy behind bundling gifts is fairly simple. Let's say you and your spouse gift $15,000 annually. Currently, with the standard deduction where it's at, even with a $15,000 gift, you may still take the standard deduction and not receive an additional charitable deduction there. So the thought process is, so let's say you were planning on making a gift in December. Alternatively, rather than making that $15,000 gift in December, you could postpone it until January of 2021. And then in 2021, you make two gifts that year, one at the beginning of the year representing 2020 and one at the end of the year for 2021. And so it allows you, in that scenario, you would gift $30,000 in 1 year, which would allow you to capture an additional deduction on your taxes. So you gift the same amount of money, but you just tweak the timing a little bit to, once again, kind of capture an additional tax benefit. All right. Something else that you could do is establish a donor-advised fund. And what a donor-advised fund is, it's essentially a charitable investment account. So they're typically established either at your local community foundation, Lehigh Valley Community Foundation. They are wonderful to work with. My family and also our business, we have donor advised funds down there. It's a really easy process. Or you could establish it at a custodian like Vanguard or Charles Schwab. You could work with your advisor to create the account. And then once you have it created, you make tax deductible contributions into it. The gifts are irrevocable, meaning you cannot take them back. Once you put the money in there, it's in there, just as if you were to gift directly to, once again, your church or maybe the YMCA, anywhere else you were to gift. Once it's there, it's there. But the really cool thing about a donor advised fund is that money can be distributed over time, and you can also grow it. You don't have to distribute it all. So you can add to it on a year-over-year basis if you're working toward an impact gift, or you want to take advantage of bundling gifts and maybe pre-fund some annual commitments that you have. And then when you're ready to take a distribution, you reach out to the custodian and you request a grant to be issued. It's actually a very clean way of giving because you receive the tax deduction when you make the contribution into the fund. You don't necessarily need to track all of the documentation for the individual grants on the back end. It's also a great vehicle if you want to quickly reduce the size of your estate for tax purposes, or maybe pair it with a windfall of taxable income, perhaps from the sale of a business or exercise of stock options. So it allows you to kind of couple different tax events occurring. And actually, I'm going to hop down here to charitable trust for a minute. Charitable trust, we wanted to include this within the presentation because historically, charitable trusts have been the go-to vehicle for charitable giving. However, with the advent of some of these other strategies, they've fallen a little bit out of favor. Just because there are a number of different trust structures and moving pieces, we are actually not going to dive into the details of charitable trust right now, once again, because there are a number of different directions that you could go with it and a lot of moving pieces, and it's probably beyond the scope of today's presentation. But I just wanted to acknowledge that some of you may have charitable trusts or may have thought about charitable trusts. And if you would like any more information about establishing one or kind of the mechanics of how they work, please feel free. I know Nick or I would welcome any inquiries that you might have, so feel free to reach out to us directly. Like I said, I didn't want to overlook that, but just wanted to reference it. But let's talk a little bit about qualified charitable distributions, or QCDs. So QCDs are available for individuals over age 70 and a half or older who have retirement investment accounts, like a 401k or traditional IRA. 70 and a half was originally chosen as the age because that was the age in which required minimum distributions began. So that's essentially when the IRS says, your money's been growing tax deferred long enough, it's time to take the money out. And when you take that money out, it's taxable income. I'll circle back to that. But that's how we started with age 70 and a half. Under the new Secure Act that was passed late last year, that RMD age has increased to age 72. And under the new CARES Act, all RMDs for this year are suspended. I just kind of wanted to make that as a side note because you might be hearing a lot about changes and when to take distributions. That being said, even though those changes are out there, a qualified charitable distribution is still an available giving strategy for this year and beyond. So once again, normally when you take money out of a traditional IRA or 401k, that money is received as ordinary income. However, if you make a charitable gift of $100,000 or less straight from the IRA directly to the qualified charity, that distribution is a non-taxable event. So you do not claim that money as income. Let's go through an example of that, and I'll show you kind of how that might play out or benefit you. And I apologize if some of these numbers are a little bit low or small. I'm sorry. I apologize if they're a little small. Let's start with the assumptions up here at the top. So this is a married couple. In 2020, this standard deduction is $24,800. This individual has a required minimum distribution, and once again, we'll assume, maybe we can assume this is 2021, a required minimum distribution of $40,000. They have some itemized deductions of $10,000. Those are excluding gifts, so other itemized deductions they have. They're planning on making a charitable gift of $10,000, and they're in the 32% tax bracket. This is a very oversimplified example, but we'll just kind of run through some basic numbers. So on this side, this is making a gift from that required minimum distribution, making a qualified charitable distribution. So if normally they would take out $40,000, but what they did is they sent $10,000 to the charity of their choice. And so they took out $30,000 for themselves, and that's what flows to their tax return. From that $30,000, they backed out their standard deduction. So now they have taxable income of $5,200. And at the 32% tax rate, their tax is a little under $1,700. So that's with the money going directly to the charity. They've reduced the income that shows up on their tax return. Now, under this side, alternatively, they've taken that full $40,000 out. They made a charitable gift. They wrote a check for $10,000, but they have to claim, since they took ownership of that $40,000 themselves personally, they have to claim all of that $40,000 on their tax return. Now, because their charitable gift of $10,000 added to their other itemized deductions was less than the standard deduction, they're just taking the standard deduction here. And so now in this scenario, they have taxable income of $15,200 or a tax of about $4,800. So by sending that money directly to the charity rather than taking it and writing a check, they would have saved $3,200. So you can see there's a significant tax benefit to gifting directly from the IRA using this qualified charitable distribution strategy versus simply writing a check. The other thing to consider here too, and I don't have it listed on the example, is that the other thing that they're doing is they are reducing their adjusted gross income. And even reducing their adjusted gross income has other benefits. It may impact their Medicare premiums for Medicare Part B or Part D. If they have a lower AGI, then they may not be subject to increases on that side. And it also may allow them to avoid the surtax, a 3.8% surtax. So there are some other kind of ancillary or other side benefits as well. All right. And with that, once again, if you have any questions, please feel free to pop them up. I'm going to hand this back over to Nick to go through a couple of other tax consequences and considerations on the giving side.
Great. Thanks, Katie. Yeah, so Katie covered very well tax consequences for lifetime gifts. I'll add in there too about that charitable distribution directly from the IRA, in addition to Medicare premiums. It may also impact the taxability of Social Security benefits, because that's going to be based on how your AGI is calculated on your tax return. So by moving funds directly from your retirement plan to a charity and not allowing that to appear as income on your personal tax return, it could also reduce the taxes on your Social Security receipts. I want to get into tax consequences primarily for testamentary gifts, then gifts upon death. And I have this broken down into 3 buckets of assets. But before I go through them, I'll summarize what I'll quantify as 3 different types of taxes that may apply as well. The first one, which isn't going to impact many people, is the federal estate tax. Over the past 10 years, the exemption amount for the federal estate tax has just taken off. There's very few people that will have to worry or plan around the federal estate tax, but I think it's worth mentioning. Where we are right now is that the exemption is $11.58 million per person. So 2 spouses, husband and wife, could each have $11.58 million as an exemption, meaning that if their estates are worth less than that, in addition to any major lifetime gifts they made, they don't have to worry about the federal estate tax. For the people who do, the few lucky ones who do have more than $11.5 million, anything in excess of that amount will be taxed at a rate of 40%. That would be a collection by IRS. So again, it's a big percentage. Once you clear that threshold, but most people, whether fortunately or unfortunately, are going to be below that threshold. The two other taxes that are going to have an impact on most people's plans are going to be the Pennsylvania inheritance tax and then any type of income taxes. So the Pennsylvania inheritance tax is funky in a way, in the sense that the rate of the inheritance tax depends on how the beneficiary is related to the person who passed away. And there's 4 different rates that would apply. So anything that would end up going from the deceased person's estates to a spouse or to a charity is going to be completely free of Pennsylvania inheritance tax. There's no tax that will be applied there. If there's any inheritance going to a child, grandchild, parent, grandparent, basically I think about it straight up and down a family tree, it's called the lineal rate, that the tax on the value of those inheritances are going to be 4.5%. If the inheritance, if anything goes to any siblings, brothers or sisters, Pennsylvania taxes those inheritances at a rate of 12%. And then anything going to anyone more distantly related or not related at all, or organizations that are not charities, Pennsylvania taxes those gifts at the rate of 15%. So when doing this plan, if you're going to involve beneficiaries who may be subject to different tax rates under Pennsylvania inheritance tax laws, it's important to understand how different assets would be taxed to each of those people. And then the final type of tax that would apply is income taxes, obviously. Some assets will be taxed after your passing, and I'll get into that in a second. Most will not, but some will. So going through the categories that are on the slide here: probate assets, life insurance, retirement assets. So probate assets, those are the assets that are in the deceased person's name when they pass away and did not have any other surviving joint account owners, did not have any beneficiary designations associated with them, are not controlled by a trust agreement. Basically, if someone has a bank account, a piece of real estate, a business interest, and it was solely in that person's name when they passed, that becomes an asset of their estate. And those assets are not going to be subject to income taxes, but they will be subject to the Pennsylvania inheritance tax, and they will be subject to the federal estate tax, assuming that the overall net worth is above that $11.5 million. Life insurance will not be subject to Pennsylvania inheritance tax or income taxes. If the decedent had more than $11.5 million, federal estate tax will apply. But again, that's very few people's situation. Life insurance is generally the best gift to give to beneficiaries who may be impacted by Pennsylvania's inheritance tax, because that is the one asset that Pennsylvania does not apply the tax rate to. So it could be a $10,000 life insurance policy. It can be $1 million life insurance policy. There are no income taxes and there are no Pennsylvania inheritance taxes, regardless of who is the recipient of those life insurance proceeds. And then finally, you have retirement assets. That generally is going to be the most taxed asset. Again, the federal estate tax will apply if you pass that threshold of $11.5 million. But even if you're under that, Pennsylvania does subject retirement assets to the inheritance tax. Sometimes I've had clients who were confused. They thought the inheritance tax only applies to estate assets, probate assets. That's not true. Even if assets pass outside the estate, such as retirement assets with beneficiary designation, Pennsylvania does impose the inheritance tax against those assets. And then in addition to those inheritance tax rates, if it's a traditional qualified plan, if it's a traditional retirement plan, there's also going to be income taxes that the beneficiaries will have to recognize as they pull the funds out of that retirement plan. So because the person who passes most likely receives some sort of income tax benefit when the funds were contributed to those plans, the beneficiaries then have to pay the taxes when they pull the money out of the plan. And I want to get into the next slide, just an example of how the knowledge of this information could have a huge impact on the tax consequences of your plan. So there's a lot to unpack on this in the slide, but I'll try to go through this as simply as possible. So I chose a person here, let's call her Nancy, has an estate with about $300,000. And it's split equally between $100,000 from cash and investments, which would be probate assets, $100,000 in a traditional IRA retirement plan, and a life insurance policy that pays a death benefit upon Nancy's death of $100,000 to whoever she designates as her beneficiary. Let's say in this example that Nancy wants to benefit 3 beneficiaries who are all subject to different tax rates under Pennsylvania's inheritance tax system. So she'll have a child that she wants to include, she'll have a nephew, and she'll also have a charity. So as I outlined with the inheritance tax rates, children are generally taxed at a rate at 4.5% by Pennsylvania's inheritance tax. A nephew, as a more distantly related person, would be taxed at 15%, and charities are not taxed at all by Pennsylvania's inheritance tax. So assuming she wants $100,000 to go to each of these before any tax consequences, she could split this up a number of ways. So the simplest way in her mind may simply be name all 3 of them as equal beneficiaries in her will, and then have all 3 of them named as equal beneficiaries on the beneficiary form for her life insurance and her IRA. If she does her plan that way, her total tax bill is essentially going to be $19,000. There's going to be $13,000 for inheritance taxes based on the child and nephew's rates for inheriting the probate assets in the IRA, but also for the IRA income that goes out to the child and nephew. There's going to be an income tax consequence on there. For purposes of this calculation, I assume they would be paying a tax rate of 25%. The charity, when the charity receives the retirement plan, the charity is exempt from income taxes. So the 1/3 of the IRA that goes to charity, that portion of the IRA will not be subject to income taxes or inheritance taxes. So overall, with this type of plan, Plan A on this slide, the total tax bill is going to be $19,000. Plan B, this to me would be the worst planning from a tax perspective. Under this example, Nancy names her child as the sole beneficiary of the estate, the probate assets, the $100,000 in cash and investment. So that would be subject to 4.5% inheritance tax. The life insurance, she names the charity as the beneficiary of that. And then she names the beneficiary of her IRA as her nephew, who would have to pay a 15% inheritance tax and then also pay assume 25% income taxes on those retirement funds. Under this situation, because she gave the most taxed asset to a nephew who's subject to the highest rates, her total tax bill is going to end up being $44,500 based on these assumptions. So again, it seems like a simple change, but that's going to have the worst tax consequences on all of this. And then under Plan C, this to me would be the most tax efficient way for her to accomplish her goals and still minimize her tax consequences. So here she could give, again, the child as the sole beneficiary of the estate, the life insurance, because life insurance is not subject to Pennsylvania inheritance tax and has no income tax consequences. That would be the best benefit. That would be the best asset to give to her nephew. And then have the IRA, which is usually the most taxed type of asset, give that to the charity, because charities, due to their exemption from IRS, pay no income taxes, and also they pay no inheritance taxes. So by understanding the tax consequences for each type of asset and for each type of beneficiary, Nancy in this situation under Plan C could minimize her total tax bill upon death to $4,500. So you can see here, looking at the bottom line of each plan, the difference of tax consequences. It could range from $44,000 some dollars down to $4,000 some dollars. And I saw that we had at least one question here while I was on the previous slide about exemption for PA estate tax. So for the Pennsylvania inheritance tax, there are some exemptions, and again, some that are taxed at a 0% rates. Again, charities and spouses, there are no inheritance taxes. As far as types of assets that are exempt, life insurance is the main one. There are a couple smaller categories. For example, family-owned businesses if a interest in a family-owned business, which is a specifically legally defined term, is passed on to other family members, that could be exempt from inheritance tax, but there are a lot of administrative steps to qualify that. Basically, the remaining family who inherits that interest from whoever passed away within the family has to spend the next 7 years sending annual reports to Pennsylvania to confirm that the business still meets that legal definition and to confirm that the interest stays within the family's hands for those 7 years. Also, I should mention that Pennsylvania has a 1-year look back on an inheritance tax. So if there are any deathbed type of gifts made to beneficiaries who would otherwise be subject to the tax, that amount is still going to be clawed back by Pennsylvania and subject to the tax, except for the first $3,000. So if there's a gift made within a year before a person passed, let's say it's $10,000, $3,000 of that will be exempt, but the next $7,000 will be still subject to whatever tax rate would normally apply. So there are some small exceptions, but by and large, say 90-95% of assets are going to be subject to the Pennsylvania inheritance tax. And with that, that brings us to the end of the substantive slides. But Katie and I want to just come back together here and see if there's any other questions that we could answer for anyone. Let me go back on. There we go. I'm too close to the camera. So again, there's a chat feature on the side. If anyone has any questions, any other questions that they'd like us to answer for them, please fire away.
I know we covered a lot of ground, so if there are some questions that pop up later that maybe you want to send to Christina or reach out to us directly, we're happy to, of course, touch on anything else later on as well. And I'm actually going to, I'm gonna pass this back over to Christina just for a minute, just to say thank you and let her put in some closing remarks. So thank you once again for tuning in today. Really, really appreciate your patience and really appreciate you kind of going through this alternative way of connecting today. So I'm going to hand it back over to Christina here.
Thank you, Nick, and thank you, Katie. We really appreciate you taking the time to meet with all of us this morning. And thank you to everyone who joined us. I hope that you had the opportunity to learn a bit more about building a meaningful legacy through your planned giving. And if you have any questions, please feel free to reach out to me. You can reach me by phone at 610-751-7070 or via email cshoemaker@valleyyouthhouse.org. Thank you again to Katie and Nick. And if you have any questions, please let us know and enjoy the rest of your day.